America's most powerful bank just made a move in the last few weeks that sends a more dangerous signal than 2008, and most people didn't even notice. No press conference, no public announcement, just a quiet repositioning, one that anyone paying attention should find deeply unsettling. Because when JPMorgan moves like this, history says the system breaks within a few years. The question isn't if you're affected. The question is, will you see it coming before it hits? If you have a savings account, if you have a retirement plan, or if you're just living paycheck to paycheck, this video is for you. Because what's happening right now isn't about Wall Street traders or hedge fund managers. This is about the invisible foundation underneath your financial life. And that foundation just shifted in ways most people won't understand until their credit gets denied, their job disappears, or their cost of living spikes for reasons nobody can quite explain. JPMorgan didn't publicly announce anything dramatic, no emergency meeting, no public management press release, but quietly, over the last 90 days, they repositioned a balance sheet worth $4.56 trillion. To put that in perspective, that's larger than the entire economy of Germany, larger than the combined GDP of 150 countries. This is not a normal bank making normal adjustments. This is the institution regulators call when the system is breaking. The bank that swooped in to buy Bear Stearns in 2008. The one that absorbed Washington Mutual when it collapsed. The one that grabbed First Republic in 2023 when regional banks started failing. JPMorgan doesn't react to crises. JPMorgan sees them coming and positions accordingly. And they just positioned. Here's what makes this move abnormal. Banks typically rebalance gradually, small adjustments, incremental changes. You don't rapidly reposition trillions unless you're seeing something that forces your hand. And history tells us exactly what happens when the biggest banks do this. They don't reduce loans because they're optimistic. They restructure because they know what's coming. In 2006, the same pattern emerged. Banks didn't publicly announce they were preparing for collapse. They quietly repositioned. They tightened credit standards while still reporting record profits. They shifted risk off their visible balance sheets while telling investors everything was fine. The public saw strong earnings. Regulators saw compliance. What they didn't see was the systematic preparation for what came 18 months later. Lehman Brothers collapsed. The global financial system came within hours of total failure. Trillions in wealth evaporated. Fast forward to today. JPMorgan Chase reported Q4 2025 earnings on January 13, 2026.
Net income, $13 billion. Sounds healthy. Record payments revenue, $5.1 billion. Record asset and wealth management revenue, $6.5 billion. But buried in the details, something stark. A $2.2 billion credit reserve established for forward purchase commitments. That's $2.2 billion set aside for expected losses before those losses even occur. And here's the key detail. Their Basel III Common Equity Tier 1 capital ratio dropped 90 basis points from this single move alone. When a bank that large suddenly reserves that much capital, they're not being cautious, they're seeing deterioration. Total assets as of September 30, 2025, $4.56 trillion. Deposits, $2.548 trillion. Loans, $1.467 trillion. That loan-to-deposit ratio matters. It tells you how much money is being deployed into the economy versus held back. Right now, JPMorgan is holding $1.41 trillion in cash and short-term investments. That's not normal lending behavior. That's fortress balance sheet behavior, the kind you build when you expect trouble. And here's the part most people miss. This isn't about JPMorgan failing. JPMorgan won't fail. They're the fortress, too big to fail, and bigger after every crisis. The danger isn't JPMorgan's survival.